Welcome to the Partify podcast. I'm your host, Roderick Jones, and I'm excited that you're joining me here on another episode. On today's episode, we're talking about the impact of interest rates on multifamily loans and on your returns. Let's get into it. So welcome to the Partify podcast, the show where we teach you how to use other people's money to finance your multifamily deals. On today's episode, we're talking about the impact of interest rates on your multifamily loan as well as your multifamily investments. Let's get right into it. So, as you guys know, we are in a transitionary phase in the multifamily market, meaning that the Fed is raising interest rates. And being that the Fed is raising interest rates, multifamily investors who own properties don't really want to sell unless they have to. And then multifamily buyers who want to buy properties can't find something to buy because the owners don't want to sell. Or if the owners do want to sell, they want to sell at a higher price. And that price just can't happen in today's market. So everything is kind of at a standstill at the moment. But the main question, or the main reason all of this is at a standstill, is because of the impact of interest rates on your loans and on the investor's returns. So let's dive into it. Interest rates affect properties in a variety of ways. So I look at it like this. When interest rates are low, that means the property prices and values are high. And when interest rates are high, the property prices and values are low. And so we've been in an interest rate environment where the cost of capital, meaning the interest rate, has been so low for so long, prices have been high, which caused, things to become inflated. Now, things can become inflated through supply and demand, but we won't get into that for this podcast. We're just going to focus solely on interest rates and the cost of capital and how they affect your multifamily investment. It affects you in three ways. Number one, it affects your loan affordability. Number two, it affects your loan amounts. And number three, it affects your loan terms. So let's dive into number one, how interest rates affect your loan affordability. So when interest rates are lower, you can go higher up into the capital stack, meaning that you can get financing for 80% of the value and you're still able to pay your debt, or you're still able to service the debt because the property is paying for it. However, when the cost of money becomes higher and interest rates go up, it affects your loan affordability because a loan at 6% looks totally different or is more expensive than a loan at 3%. If you get a loan at 3%, you can afford to pay a little bit more for the property because your debt service isn't going to be high. But when you get a loan at 6%, that's double what you were just paying, and that means that your loan proceeds are going to come down some if you want an affordable payment, And when we say affordable payment, we're not talking about paying on your single family property and things like that. We're talking about paying on your multifamily investment property. These are properties where you're going to get investors to come in and invest money into your deal. You're getting sponsors. You're putting together a team of sponsors. You're making it very professional. And so when we say affordability and affording your payment, this is your annual debt service coverage that you're going to have to pay. And after you pay that debt service, whatever you have left, that's what's able to go to investors. And so when you have a deal where your debt service is super high, and when you buy the property, the only thing you can do is afford to pay the debt service, that means that you aren't able to pay your investors. And when you aren't able to pay your investors, that creates more problems. And that generates lower returns for your investors. And it also hurts your track record. So that's number one. Multifamily loans and interest rates impact your loan affordability. Number two, interest rates affect your loan amounts. We hinted on this before. Maybe you were able to get 80% loan of value with a 3% interest rate. But when you're looking at it now, you're only able to get 70%, maybe 60% loan of value with a 6% interest rate because the cost of capital is higher. So that's how it's going to affect that. And then let's move over to number three. It affects your loan terms. Some banks and lenders were able to do bridge loans at 6% or 4% and able to do it in 1 to 3 years. Now they're tightening those constraints, saying if we give you this bridge loan, we would prefer you to be out of this bridge loan in 1 year. And if you aren't able to do that, then don't accept our loan. And so being that interest rates are becoming higher, everybody is getting a little bit more worried. Loans are becoming more constrained, and it's just going to make you navigate the waters totally different than you navigated it in the previous 2 years or in the previous 6 months. And so here are the 3 ways. Let's recap those 3 ways before we move on to the next thing. So the 3 ways that interest rates affect your multifamily loans. The 3 ways that interest rates affect your multifamily loans is this. Number 1, it affects your loan affordability. Number 2, it affects your loan amount. And number 3, it affects your loan terms. Let's move over to the impact. So how does interest rates or rising interest rates impact your multifamily investment returns? The number 1 way that it's going to impact your multifamily investment returns is your terminal value. So as I said before, when the cost of capital is low, the prices of multifamily buildings are high. And when the cost of capital is high, the price of multifamily buildings is low. So in this case, being that the cost of capital is high, multifamily values are going to start to come down. They're already coming down. And if you're in a deal where you were assuming that you were going to cash out at a 5% cap rate and it's a B-class property, and now Feds have increased interest rates, now that same B-class property may be worth 6%. Now that same B-class property may be worth 6.5%. And what that does is it decreases the amount that you get out of the property. So maybe you're not able to sell it for $5 million now, and you can only sell it for $2 million. Maybe you're not able to sell it for $10 million now, and you can only sell it for $6 million. That's the difference that we're talking about here. When interest rates go up, when interest rates go up and the cost of capital go up, the price of your buildings come down. So this is a bad thing if you are an owner looking to cash out. But this is a good thing if you are a buyer looking to buy, because you can scoop up more deals now at a fair price than it was in the past. So the rising interest rates affect your multifamily investment returns in 2 ways. If you're buying, your terminal value is going to allow you to buy properties at a decent basis. And if you're selling, you're going to sell properties at a lower basis. And that's going to affect how much returns your investors get. So what are some strategies to mitigate the risk, to make sure that these rising interest rates don't really affect you that much? So if you're a seller and you'd really prefer not to sell, you're going to have that talk with your investors and say, hey, we're going to need to hold your capital for a little bit longer. We're going to change our strategy to a little bit longer hold time, and then we'll be able to cash you guys out in the next 5 to 10 years. But for now, we need you to ride the wave out with us. And so while your cash out or your terminal, like if you have a cash out coming up or you have a loan coming due or a bridge loan coming due and you need to go ahead and get out of that, maybe you don't pay investors back at that moment. If investors are willing to stay with you for the long term, you tell them, we're going to roll you into this longer term deal. We're going to refinance out of it. We won't make any money on the refinance, but you will get cash flow once we refinance into a better loan. So that's one way you can do it. Another way you can do it is make sure when you're buying deals today that you're not maxing out the loan proceeds. If you're approved for 80% loan to value, maybe optimize your capital stack to where you can get 60% loan to value, or take on 55% loan to value, and then you raise a little bit more equity. In the short term, you won't be able to pay investors back the current high prefs that everybody's paying out right now, but in a longer term, it will have a bigger payoff when it's time to recapitalize the project or sell the project within 5 to 10 years from now. And then lastly, make sure that the property can service its debt. As interest rates go up, we know that the price is coming down. So don't overpay for a property. Make sure the property can service its debt, and make sure that make sure that you have enough equity raised to weather any storm that's coming. So that is it for today's show. Let's go ahead and recapitalize this thing. So interest rates affect your multifamily loan proceeds in 3 ways. 1, it affects the loan affordability. 2, it affects the loan amount. And 3, it affects your loan terms. The number 1 way that interest rates affect your multifamily property returns is the terminal value. If you're selling, your terminal value is going to be lower when interest rates increase. And if you're buying, you can buy properties at a stronger basis because the cost of capital is higher. And then lastly, you decrease or mitigate risk by making sure you don't over leverage, making sure you pay a strong price, and making sure that you raise enough equity. So that's it for today's episode. I will see you. Make sure you leave a like, make sure you review, and make sure you subscribe to the show. And I'll see you on the next one.